It's 8:01 a.m. Chicago time, 9:01 Eastern on Tuesday, the 6th of June, 2017. It is my son's birthday today. He's turning 12. That's a big day. Um, Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. I'm not going to go over the news much. You can figure that out. You can figure that out on your own. A couple of key items that I came across is that the 10-year is at its lowest level since the days following Trump's election. 10-year yield, that is. The U.S. 10-year yield is down by 3 basis points at 2.15%. We haven't seen that level since November 10th, which is a couple of days after the election. Other key elements, the World Bank sees global growth forecast 2.7%. Apple released its HomePod and some updates to its to a bunch of products in its Worldwide Developer Conference. And then in economic news, sorry, hang on, I'm on the wrong page. In economic news, not seeing much across the board. Eurozone Syntax investor confidence came in stronger at 28.4 versus 27.4, highest reading since July 2017. However, in the overnight, we saw the market dropping on the Asian Open and then dropping again on the European Open, and is trading lower than yesterday's range. There's some special things to talk about with regards to yesterday. Let's switch gears real quick. Actually, let's go over today's releases, whatever's left at 10 a.m. Eastern. 10 a.m. Eastern, that's 3 p.m. GMT. There will be the JOLTS job openings number for the U.S. for April, expecting 5.75 million job openings. And then we're getting API crude oil inventories after the close. I'm not seeing any speakers or anything of significance for the rest of the day. Expected to be a light day. The market's expected to move under its own power today. So let's take a look at what we expected yesterday. Here we go. So yesterday, the primary expectation is a pretty dull open. Expected the market to push down to 24.33 or so, 24.34, 24.33. And then expected 7 points of rotation on the RTH from low to high. 7 points. I put it right here on the YouTube stream from yesterday. You're looking at yesterday's YouTube stream. So expected 7 from low to top. I expected the high to be taken out since the point of control the prior day was near the high, and the market held those prices into the close, did not sell off on Friday. So the expectation is that that high at 24.39.75 would be breached, at least 24.40, before we run into some strong resistance, and that would give us about 7 points of range with the LVN right here being tested, right? So that did not, it happened, but it didn't happen. It happened the way we see it here. We dropped to about 33. But we just could not get out of the range at all. Yesterday was super dull. The secondary hypothesis was a test higher initially, initiative higher, and then looking for initiative lower, responsive lower, and then the market to finish somewhere in the middle. That didn't happen at all. And then the tertiary hypothesis is the market bounces, bumps down to 33, and then has an impulsive move out as buyers rush in to take the market back up to continue the trend, which did not happen. So of the three, Hypo 1 worked out to about here. We never took out the high. We never got the 7 points of range. It was a lot worse. Here's yesterday's range. I mean, it's incredible. I've got a 2-tick Renko on here, which is pretty tight. Not sure why my OS is down here. Hang on. Got a 2-tick Renko, which is pretty tight, yet it still did not. The image on the screen, given the bar size that I'm using here, did not even take up a quarter of the screen. Look at this. And normally this would take up, you could see Fridays took about half the screen, which is pretty slow. Most days take about three-quarter of the screen at this resolution. And yesterday just took up probably 15% of the screen. That's very little action. Remember, a two-tick Renko only prints when the range is achieved. And the things you should note about yesterday, so we dropped to 33.50, which is where we expected, right? That's what we talked about. 33.50, then rotation of 7 points to 24.40, 24.41, and then back into the range for the day. That's the expectation. And yesterday we had this nice rotation up, set us up for a mid-long right here. Did not work out. Ended up getting pushed out for a stop, an early stop or the quick stop. And so by the time by the time this thing worked itself out, it started to sell off into the close. We had basically only achieved about 5.5 points of range. 5.5 points of range. Of course, we had the Whit Monday holiday, so there was a holiday in Europe. But still, the U.S. stock market was open. The expectation was we would move under our own power, and at a minimum, test this 39.75 and 24.40. So yesterday was unique in that we had what's called a normal day, almost a non-trend day, but a normal day. A normal day means it actually is a misnomer, in my opinion. A normal day occurs 3% of the time or 2% of the time, in that the initial balance, the first hour's high and the first hour's low, is never breached. That only occurs about 2% of the time, 2.4% of the time on the last update on that study. 2.4% of all days do not breach the high or the low of the first hour or the initial balance. So yesterday was tough. It was very quiet. It was very sideways. We have a very, very Gaussian profile here with a very, very valid high kurtosis value area. The market's very compressed based on yesterday's action. Yesterday did not have all that much to report. I mean, the value area was only about 2.5 points. 2.5 points, one rotation is the entire value area. It's incredible. It just feels like summer already, and the market's just not shifting, not moving around at all. So when we look at the big picture and look at what the stats look like on this particular day, when we come down here, we see that this chart here covers the range. This is the range low to high of RTH. Okay? So we're measuring the low point to the high point of the pit hours. This goes back to August 24th of 2015. And what we have here on the right is the profile that shows us how the distribution, how the market's ranges are distributed. Okay? And what we would consider to be common, the most common, is listed right here at 11. Value low is at 7. Value high is at 23. So what we would consider to be normal, or 68, call it 70%, or one standard deviation of the data set based on the mode or the highest, the point of control. The range we would expect in the S&P is to be between 7 and 23 points. 7 on the low end and 23 points. What we had yesterday was 5.5 points. That is below normal. We are in the second standard deviation area, which has a limit of 5. So we are on the edge of the second standard deviation. So there's only about a 2% chance that we would get that smaller range, and we got it yesterday. Again, that ties in with the 2% chance, 2.4% chance that the IB high or low is not broken. And then when we look at the volume, which is represented here, RTH volume, the normal volume is around 1 million contracts in the RTH. There it is, the mode. So you look at this mode right here, which is the mode is just measuring the most common occurrence. The mode's about 1.05 million contracts per session. The value area is between 1.65 million to 850,000 contracts per session on the RTH. And yesterday came in at 741,000. 741,000. So yesterday was below, again, below value low. Value low is at 850,000 right there. So yesterday had the second in the range of second standard deviation, within the second standard deviation range of range and volume. What does that tell us? What is all this saying? It's saying these are very, very unusual times. Okay, so that's the point I'm making. So you as a trader, it basically means that you need to chill and just let the market kind of play itself out. It is not a high probability or high opportunity um, cycle right now, and it's just the way it is. Okay. So as you're planning out your day, I'm seeing, watching risk for stage five, I'm seeing a lot of people just betting way, way, way too heavy. Uh, on some sort of a breakout. And as I warned yesterday, the range is likely to be compressed and it's likely to be trapped, and it just isn't smart to go in and try to push for a trend like we saw on Thursday and parts of Friday. We're opening out of range. Okay, we're opening below range. We had a sell-off in the overnight, but still we're in the two-day value. I just put in this profile right now here to show where the resistance is. Right now, resistance is resting at 24.3650 or so. And actually, it starts at about 24. Starts down here with the LVN that we've been talking about at 24.34, and it goes up to 36.75. So to me, I'm looking for responsive buying on the open. I'm looking for the market to buy up this sell-off on the open, and I'm expecting the first target to be 24.34, and then the ultimate target or the key target for the day to be 24.36. That's my main play for the day. So let's look at the hypos. Here we are. We're trading down here. I could show you, let me show you the overnight just for consistency. There's the overnight, okay? So this is what we did overnight. We opened and then we sold off right here on the Asian Open, and then we sold off again on the European Open, and we sold off one more time at 6:30 Central, 7:30 Eastern this morning on the notes opening. We're holding a downtrend channel right now, but I'm expecting this to be responsive and to start shifting up. The overnight inventory is short, is mostly short, and it's in price and in volume. And coming into today, my expectation is for an open test drive up responsive. I'm looking for a reaction at 34. I'm looking for it to consolidate, push through again, attempt to get at the 36, and then hold steady into the close in this area. That's my hypo one. Hypo one is looking to buy. So I'm looking, my big trade of the day coming in, or the key trade of the day, is hypo one, responsive buying. Okay. The better trade is hypo two, which is initiative selling. That'll give us more volatility. The volatility cycle is very, very tight. Volatility is very low. It reached 9.58 on the VIX. 9.58 on the VIX. So premiums are very low right now. The market's not expecting much volatility, and it's not pricing that into the price of insurance on options. And so that cycle is likely to change, but I'm not going to call it today. It is Tuesday. There's a good chance I might do so today, but I'm looking for an initial response that fails. I'm looking for a lower high, and I'm looking for it to start moving towards 74, 75, and then starting to tackle all the way down to this high volume node down at 24.15 would be great, but it's unlikely. But I'm looking for an open auction that becomes responsive, and I'm looking for failure below the opening swing. And then if I get failure below the opening swing, I'll start looking for pullbacks to short. Look for offers, white lines on your heat map on Bookmap. Get short and then look to ride it. Now remember, shorts don't bode very well here, unless there's news, unless you know our president does something or somebody does something somewhere. The shorts are very, very short-lived, and so you don't want to overstay short. If you're trading one lots, it's tough. You have to set a fixed target and just get out, make it a modest target on the short side, probably not more than about 4 points. But if you trade multiples, make sure you take something off and let the second one ride, or the third one, or whatever it is, the last one ride, because chances are you'll see a bounce, a pretty strong bounce on the close, as we've seen pretty persistently with this market. Okay, so don't overstay your shorts. The market does not tend to hold on to shorts for very long. We are in a bull cycle. We remain in a bull cycle. We've been in here for several years now, and we tend to not hold the market down as it auctions down. In other words, we tend to find buyers much more easily than we find sellers in this market. Okay, so those are the two main hypotheses. I want to remind you today of 4:30 at 4:30 Eastern. We're doing a convergence event covering the latest tools, statistical studies, and things like that, using Linsoft's IRT, which is a software that I use to chart. For those of you who have it, this would be an important thing to attend. If you don't and have considered it, you might want to listen in. In either case, go into the description of this video and click on the invitation. There are two events. Today we have a convergence event, and tomorrow we have an AMA, a public AMA with Futures IO. You can register for both so that you can get the recording even if you cannot attend. Okay. The last thing I want to tell you is trading has not been so great. Okay. Uh, that's okay. It's just part of the cycle. It's just part of the business. It hasn't been great. So this is a good time to be patient and to be grateful, to show gratitude. I just want to share some statistics with you that you should take with you for the rest of the day, just to understand that you're fortunate. Just the fact that you're listening to me. 42 million people in the US are food insecure, meaning they don't know where their next meal is coming from. So be thankful for what you have. Worldwide, there are 108 million people who are severely food insecure. In other words, they have not eaten for days and don't know where their next meal comes from, generally in war-torn areas or impoverished areas. Why am I telling you this? I'm not trying to get you to donate. I'm not fundraising. I'm telling you this so that you know that you are lucky. Just learn to be patient and have gratitude for your trading, and to take that forward as a human being, who may be complaining about how bad trading has been lately, because I'm getting a lot of emails complaining about trading. Just want to remind you, we're fortunate to be here. Good luck, everyone. Take care.